Okay guys, today we are going to look at Nvidia shares. So the share price has dropped almost 50% from its all-time high from $320 to $180. So today I am going to review on whether now is the right time to buy Nvidia stock. So moving on, I will look at 7 factors which I always look at in all of my video. So if you guys have any question, you guys can see my tutorial video in my YouTube channel. It should explain what all these 7 factors mean. So moving on to my first factor, which is current asset and current liability. So the current asset of Nvidia is significantly more than the current liability of Nvidia. Therefore, the company has enough asset to cover its current liability and should not go into any liquidity issue in the short term. And please note that a decrease in current asset from January 2022 to October 2022 is due to the repurchase of share that Nvidia has done. Honestly, if I'm the shareholder, I won't be very happy with this decision because the share is repurchased at, in my opinion, is quite a high price. So moving on to return on invested capital. So return on invested capital shows how well a company can make use of its cash to generate profit. So the return on invested capital in 2022 is estimated to be around 9.1%, which is above 9%, which I consider as quite good for a company. But if you look at the return on invested capital for last year where the profit is higher, then it will be significantly higher than 9.1%. So I would say the return on invested capital is one thing that Nvidia is doing quite well. So moving on to our next factor, which is price to free cash flow ratio. So to calculate the price to free cash flow ratio, we take the market cap divided by free cash flow. So for free cash flow, I take the average of 3 years. Then it will get me a price to free cash flow of 78. So what 78 price to free cash flow actually means is that if the company gives 100% of the free cash flow back to the users, it will actually generate around 1.28% dividend for the shareholder. But as you can see from this screen, you can see that the investing cash flow and the financing cash flow is also quite significant. So in the short term, the company won't be able to provide such a high dividend until they settle their debt and also other financing cash flow and also their investing activities. With that said, the 3-year average cash flow I use might not be too accurate as you know in 2022 profit of the company dropped by quite a lot and therefore this 5.699 would be actually quite high relative to what you are going to see in this year financial report. So just take note of that. So actually the price to free cash flow, if I ignore the outlier in 1st of January 2022, it would be around more than 100. So I would not buy this stock if I base it on only this factor as you can get a better returns by investing in fixed deposit and also government issued bonds, treasuries. As you know, the interest rate currently is quite high. So if you look at the capital expenditure, which also affect the free cash flow, it has been increasing for the past few quarters, and also it is estimated that the capital expenditure will stay around 500 million to 550 million in the fourth quarter. So if people are valuing the stock based on free cash flow, then this will affect the stock price going forward if the trend continues. Next, we are going to look at non-current asset and non-current liability. So if you look at this screen, the non-current asset is 17 billion and the non-current liability is 12 billion. So they have sufficient non-current asset to cover its non-current liability. So the company should be in quite a stable financial position in the long term. You can also infer that if the company generate a free cash flow of around 4 billion per year and use 100% of the 4 billion every year to pay off its non-current liability, the company could actually be debt free in around 2 to 3 years time, which is actually quite good and rarely seen from company. Okay, so moving on, we'll be looking at the growth rate of Nvidia. In a stock price, generally, investor will price in the growth of the stock into the price of the stock. So moving on to find out how much growth have been priced into the stock, I will use this formula by using the current price to earnings ratio divided by future price to earnings ratio minus 1. So this formula is actually generated using the logic that if current price to earnings ratio is equal to future price to earnings ratio, then the implied growth is zero and any growth in the future hasn't been priced into the stock. So when you are buying a stock, the best situation is you find a stock that actually price relatively less growth or a stock that price negative growth, which is possible sometimes. So in this scenario, I assume that the future PE in 5 year time is 25 and the current PE is the calculation by taking the current price of the stock divided by the earnings per share of the stock. So 1.45 is actually my estimate for Nvidia earnings in 2022. So using this formula, the implied growth for 5 years is 492%. So the growth per year com is 37.5% compounded annually. So what this means is actually if you want to earn a profit on this stock, the earnings of the company have to grow more than 492%, then the extra will go into the stock price. Moving on, we'll look at the actual growth versus the implied growth. So as I have calculated, the implied growth is around 37.5%. So if we look at the growth last year, it's actually negative. And if we look at the revenue estimate that the company has provided us in Q4 this year is 6 billion, which is actually the same as Q3, which is why I estimated the net income per share to be 1.45 at the end of this year. So in addition, there are a lot of macroeconomic factors such as their business in China that are affected by the ban set by US. So I am not very optimistic about the growth and I really doubt that the company can grow at a 32.36% over the next 5 years. Therefore, it is a very risky stock to me right now. So next, we'll look at the issuance of shares. If you look at this screen and the share issued over the last year, the company actually brought back quite a number of shares, so around 1.5% of the shares was brought back this year. So this is actually a good thing as I state at the beginning of my video. The lesser share, the more earnings the shareholder is entitled to, and therefore the share price will increase generally. Moving on to the last factor, which is price to earning ratio. This factor, in my opinion, is the most important factor. And as you can see, that the net income this year that Nvidia did was around uh, 2 million plus for the first 3 quarter, and I extrapolate the results to 1 year, so it's around $3.9 billion. So using this number, I will estimate the P/E ratio for this year after the Q3 result. It will be around 112. So 112 P/E ratio is actually quite high, as the average P/E ratio of stock is around 15 to 16 according to historical data. So I would say a substantial amount of growth is priced into the stock right now, and the stock has to significantly outperform in the upcoming 5 years for it to actually meet the expectation of the current share price. So this is one reason that I would not buy the stock right now. So if I just do some estimate, for example, I put some assumption that the stock will grow 10%, 20% per year. And my estimate for 2024 earnings is that it will revert back to normal, which is the earnings of Nvidia in 2022. Uh, and then I will use this amount and I will compound the growth rate of the earnings by 10%, 20%, 30% respectively to get the earnings per share 5 years in the future. And I will also adjust it for the share buyback, assuming that the company buys back 1% of share per year. So actually, if you look at my assumption over here, it is actually quite optimistic that I estimate that the earnings of the company will actually rebound back to 2024, which means the recession will actually end and recover in 2024. Um, I think that is overly optimistic, but let's just take this for example. So if I assume that the earnings per share is 5.39 and the PE ratio in 5 year time of Nvidia is 25, it will give me the share price in the second last column. So with that, I can calculate my gain if I buy at today's price. According to my forecast stock price in the second last column, I could calculate the estimated gain. I would gain over 5 years, assuming that I buy the stock at the price today, which is $178. So to actually gain a profit of 25%, the company need to grow 30% from year 2024 onwards until 2027. This might be quite optimistic, and I would suggest that you just invest in the government treasury, which give you around 4 to 5%, and you compound it annually for the next 5 years. You could most probably reach 25% gain in the next 5 years. This is the reason I would not buy the stock today. So my conclusion for this video is that if you are invested, you should actually trim your position. And if you are not invested, do not invest in this stock. You can actually wait for the stock price to fall until around $100 or maybe around $110 where the support is. Then you can consider buying the stock with a lesser risk and a more margin of safety because of the lesser implied growth when the stock price fall. Okay, so this brings me to the end of this video. Thank you for watching. If you have any comment for my video, please leave your comments in the comment section below, and also please remember to like and subscribe my video. Thank you. See you in my next video.